No more income taxes on Social Security. And every retiree said, wait a minute, you mean the money I already earned, already paid into, and already waited decades for? Yes, that money, said Trump during the 2024 election campaign. Now fast forward to today. Fireworks, flags, hot dogs, and boom, the One Big Beautiful Bill Act, aka OBBBA, becomes law. But here's the twist. The bill does not completely eliminate taxes on Social Security. However, and this is important, it does something else. Something easier to miss. Something accountants immediately noticed and seniors absolutely needed to understand. Instead of killing Social Security taxes outright, the bill creates a brand new extra $6,000 deduction just for seniors. Now, before your brain goes, great, sounds complicated, I'll ask my accountant. Take a breath. You don't need to be a tax expert to follow this. In this video, I'll walk you through it step by step in plain English so it actually makes sense. I'll be answering the questions seniors are already asking. Who qualifies? Does this apply to 2026 taxes, or is it one of those future you problems? To answer that, we need to back up just a bit and look at what Congress actually passed. On July 4th, 2025, fireworks went up, and so did a very large tax bill. The One Big Beautiful Bill officially became law. Here's the first hard fact that matters. Without this bill, the 2017 tax cuts were scheduled to expire at the end of 2025. That meant higher tax rates, smaller deductions, and a surprise tax increase starting in 2026, including for retirees. Congress stopped that. The lower tax brackets and the higher standard deduction are now locked in permanently. That alone prevents a tax hike for millions of seniors. But that wasn't the real change. On top of keeping the old rules in place, Congress added something new. A brand new deduction just for seniors. And this is where the math on your tax returns starts to shift. Starting in tax year 2025, anyone aged 65 or older can claim an extra $6,000 deduction per person. Married couple, both over 65? That's $12,000 on top of the regular standard deduction. So let's slow this down with numbers. Before this new law, the IRS basically drew a line in the sand. If you were a single senior, $16,950 of your income was protected from tax. Anything above that started counting. For married couples, that protected amount was $33,100. That was the old world. Now let's look at what changed. Nothing was taken away. Congress didn't replace anything. They stacked something new on top. So today, a single senior doesn't just get one deduction, they get 3 layers working together. The regular standard deduction, the extra amount for being over 65, and now this new senior bonus deduction worth $6,000. When you stack those 3 together, the IRS can't touch $23,750 of income for a single senior. That's $6,800 more dollars protected than before. For married couples, the jump is even bigger. Before, $33,100 of income was shielded. After the new law, when both spouses are over 65, that shield grows to $46,700. That's $13,600 of additional income that simply doesn't count for federal tax purposes. Now, here's why that matters. Under the old system, the IRS had tripwires built in. Once your total income crossed certain thresholds, they didn't just tax your pension or IRA withdrawals, they reached into your Social Security too. First, up to 50% of your benefit became taxable. Cross another line, and that jumped to as much as 85%. It didn't matter that Social Security benefits were your retirement money, the IRS still wanted their cut. For married couples, if that number is $32,000 or less, Social Security isn't taxed at all. Between $32,000 and $44,000, up to 50% can be taxed. Above $44,000, up to 85% can be taxed. For single filers, those lines are $25,000 and $34,000. Those thresholds never changed. What changed is how easy it is to stay below them. With the new deduction in place, taxable income drops. When taxable income drops, provisional income drops. And when provisional income drops far enough, Social Security slides out of the taxable zone. That's why under the new rules, about 88% of seniors receiving Social Security are expected to owe $0 in federal tax on those benefits. Before this change, that number was closer to 64%. That's really what this bill does for seniors. It doesn't make big promises, it just changes the math. But once people notice their tax bill shrinking, something else takes over. Because taxes aren't the most expensive part of retirement, healthcare is. And that's where things start to feel different. For years, many seniors were protected by something they didn't even know existed: automatic enrollment into certain Medicare savings programs. These programs help low-income seniors pay for Medicare Part B premiums, deductibles, and copays. No forms, no annual panic. Under the new bill, that automatic enrollment was turned off. But Medicare itself is not cut. Your Medicare card is safe. What changed is the extra help layer. Before the bill, if a senior qualified financially, the system often enrolled them automatically. After the bill, seniors must apply, reapply, and re-verify eligibility on their own. Now, let's put numbers on why this matters. In 2026, the Medicare Part B premium is about $202 per month, or $2,424 per year. Medicare savings programs often covered that cost for eligible seniors. If the assistance stops, either you didn't enroll or you missed filing, that $202 comes straight out of the Social Security check until everything is sorted out. So if someone is receiving around $1,800 a month from Social Security, losing that help means that they're suddenly living on about $1,600 instead. Same expenses, same needs, just less money coming in. For some seniors, this won't be an issue. If you're comfortable with forms, online portals, or you have someone helping you stay on top of deadlines, you'll likely keep the assistance without interruption. But for others, especially those dealing with health issues, mobility limits, or paperwork confusion, even a temporary lapse can create real financial stress. And that's the trade-off built into this change. The tax relief, on one side, comes with more responsibility on the other. If you're organized, informed, digitally comfortable, or have family helping, you'll likely reapply on time and keep the assistance. But if you're homebound, confused by paperwork, unaware the rules changed, or simply overwhelmed, you can lose help, not forever, but long enough to feel financial pain. And this wasn't accidental. Supporters of the bill accepted this trade-off because tightening enrollment rules reduced federal spending. Those savings helped pay for the tax relief seniors are enjoying on the front end: less automation, more responsibility. Which brings us to the situation most seniors are already dealing with every day: the cost of living squeeze. Before this law, the pattern was pretty frustrating. Income stayed mostly the same, but expenses kept creeping up. Social Security had cost of living increases, but they often didn't keep pace with what people were actually paying, especially for healthcare, housing, and utilities. This bill doesn't change Social Security payments. There's no bonus check, no adjustment to how benefits are calculated. Instead, it changes the outcome in a different way. And here's how that works. Your Social Security stays the same, but your deductions go up. When deductions go up, taxable income goes down. When taxable income goes down, your federal tax bill shrinks, sometimes all the way to zero. So even though your benefits didn't increase, the amount you get to keep does. For many seniors, that works out to about $1,200 to $2,000 a year in tax savings, depending on income. That's roughly $100 to $160 a month staying in your pocket, enough to help with groceries, prescriptions, or the electric bill. It doesn't feel like a raise on paper, but it feels like one in real life. That's why a lot of seniors describe this as a silent raise. Nothing flashy, just a little more breathing room. But, and this is the line that matters, this relief is not evenly distributed. This bill isn't really designed for very low-income seniors. Most of them were already paying little or no federal tax, so there isn't much to reduce. And it's not aimed at wealthy retirees either. At higher income levels, the deduction starts to phase out. The real impact shows up in the middle. Seniors over 65 who have Social Security plus a small pension, maybe some part-time income, maybe withdrawals from a traditional IRA. Married couples filing jointly tend to see the biggest effect. These are the households where the new deduction actually changes outcomes. And that tells you a lot about the thinking behind the bill. The goal wasn't to expand benefits, it was to prevent tax increases on ordinary retirees without growing long-term spending. Now here's the detail almost everyone misses. Some parts of this bill are permanent, some are temporary. Lower tax brackets? Permanent. Standard deduction structure? Permanent. Estate tax thresholds? Extended. But the extra $6,000 senior deduction is different. It expires after 2028 unless Congress steps in. That means seniors are living inside a window, a good one, but a limited one. From this year through 2028, the rules are unusually favorable. And that window creates an opportunity, a chance to move money deliberately while taxes are lower than usual into something that won't be taxed later, like a Roth IRA. And that's where this starts to get practical. This law doesn't talk about Roth conversions in big, bold letters, but it makes them far more useful for the right seniors. To make sense of this, you need to understand how these retirement accounts actually work. So, a traditional IRA is built around paying taxes later. Most people didn't pay taxes when the money went in. It grew without taxes for years. But when the money comes out in retirement, the IRS treats every dollar as income, and it is taxed as such. Not to mention, at a certain age, you're forced to take money out whether you need it or not. A Roth IRA works the opposite way. With a Roth, you pay the tax first. After that, the money grows without future taxes. When you take it out later, it comes out tax-free. And there are no required withdrawals pushing income into years when you don't want it. A Roth conversion is simply moving money from a traditional IRA into a Roth IRA. When you do that, the IRS looks at the amount you move and says, that counts as income this year. Normally, that would trigger a tax bill. And this is the part that matters. Roth conversions are not automatically tax-free. There's no special exemption. The only reason a conversion can happen without creating taxes is if your taxable income is already low enough and your deductions are large enough to absorb it. That's what this new senior deduction changes. Because deductions are higher now, many seniors have income space they didn't have before. Space where income can be recognized without crossing tax brackets, without pulling Social Security into taxation, without triggering higher Medicare premiums. In those years, a portion of a Roth conversion can fall into that unused space, not because the IRS ignores it, but because the math never gets high enough to generate tax. So what this strategy really does is let you choose when you pay taxes, or in some cases, lock in years where you effectively pay very little or none, instead of being forced to pay later when rates, required withdrawals, and premiums may all be higher. Once the money is inside the Roth, it's done. No future taxes on growth, no taxes on withdrawals, no required distributions forcing income at the wrong time. That's the opportunity this window creates. It doesn't mean everyone should convert, and it doesn't mean every conversion is tax-free. It means that for a few years, the numbers finally line up in a way that usually don't. This makes more sense if we slow down and look at one of these households. Take Blake and Bea. They're a married couple living right in the middle of the chart, about $72,000 of total income, roughly half from Social Security, and the rest from other sources like a pension or IRA withdrawals. Before this law, that income level was a problem. Once their income crossed the IRS thresholds, Social Security didn't stay protected. First, part of it became taxable. Then at higher levels, as much as 85% of it got pulled into the tax calculation. Even though Social Security was their retirement money, the IRS still treated it like taxable income. That's what the old rules did. Now, look at what changes under the new law. Blake and Bea don't lose anything they already had. All the existing deductions stay in place. But on top of that, they get a new senior deduction because they're both over 65. That extra deduction lowers their taxable income just enough to keep them below the IRS tripwires. And once that happens, their Social Security drops out of the tax calculation entirely. That's why on this table you see a $12,000 deduction creating more than $14,000 of tax impact. The deduction isn't just reducing taxes dollar for dollar, it's changing whether Social Security is taxed at all. For someone like Avery or Bailey, single filers in that same middle range, the effect can be even stronger. A $6,000 deduction can protect far more than $6,000 of income by keeping them under the line. Very low-income households don't see much change because they weren't paying much tax to begin with. Very high-income households don't see much change as well because the deduction phases out. The benefit lies in the middle, and once Social Security drops out of the taxable zone, something important happens. You get room. Room to recognize income without triggering taxes. Room to move money strategically. Room that didn't exist before. That's where planning choices like Roth Conversions suddenly start to make sense. Now imagine a married couple, both over 65, living off Social Security plus some other retirement income. After all deductions are applied, the standard deduction, the age-based increase, and the new $12,000 senior deduction because they're a married couple, this couple's taxable income for 2026 comes out to about $23,700. That number matters. For married couples filing jointly, the 10% tax bracket goes up to $24,800. So at $23,700, this household is still entirely inside the lowest tax bracket. Now look at what that creates. This couple has money sitting in a traditional IRA. That money has never been taxed. If they wait, future withdrawals, especially required minimum distributions, will be fully taxable. So instead of waiting, they decide to move some of that money now. They convert $12,000 from the traditional IRA into a Roth IRA. Normally, that $12,000 would count as new income and trigger taxes. But in this case, the senior deduction acts like a buffer. It absorbs the conversion before it creates a federal tax bill. Nothing here was hidden. The income was reported. The IRS saw it. The math just never got high enough to trigger tax. And even after that conversion, they're not pushed into high tax territory. Income above the 10% bracket doesn't jump to extreme rates. It moves into the 12% bracket, which runs all the way up to $100,800 for married couples. That means this household can continue moving money out of a traditional IRA slowly while taxes are still very low. Once the money is inside the Roth, it's done. It grows tax-free, it comes out tax-free, and it never forces withdrawals later in retirement. They're essentially building a tax-free inheritance for their grandkids, while the sale on tax rates is still active. There is a catch to all of this, and it shows up in the fine print. The extra senior deduction doesn't last forever if income climbs too high. For a married couple, once total income reaches $150,000, that $12,000 deduction starts to shrink. For every dollar earned above that level, 6 cents of the deduction disappears. And if income reaches $250,000, the deduction is gone completely. Now, imagine a retired couple with a traditional IRA and income sitting close to the $150,000 phase-out line. They want to avoid pushing their income any higher because once they cross that line, the $12,000 senior deduction starts to disappear. Every dollar above $150,000 chips away at it, and losing that deduction can trigger higher taxes and higher Medicare costs at the same time. Now, normally, if this couple needs money from their IRA, they take a withdrawal. The IRS treats it like a paycheck. It shows up as income. It pushes them closer to or over that $150,000 danger zone. But there's another option. Instead of taking the money themselves, they tell their IRA custodian to send $5,000 directly to a charity they support. This is called a Qualified Charitable Distribution, or QCD. Here's why that's powerful. That $5,000 never shows up on their tax return as income. It doesn't get added and then deducted later. It simply disappears from the IRS's view. On paper, it's as if the money was never theirs. Because of that, their adjusted gross income stays below $150,000, which preserves the full $12,000 OBBBA senior deduction. And there's another layer. Even while taking this standard deduction, they get the full tax benefit of that $5,000 charitable gift. Under the old rules, you usually had to choose, either itemize your donation or take the standard deduction. With a QCD, they get both. There's a third benefit too. By keeping income lower through QCDs, they also avoid IRMAA surcharges. Those are the high-income Medicare penalties that can sharply increase monthly premiums, in some cases nearly doubling what someone pays for Medicare Part B. So that one move does 3 things at once. It keeps income below the $150,000 phase-out line, it protects the $12,000 senior deduction, and it helps avoid higher Medicare premiums. That's the synergy in this strategy. It's not about chasing loopholes, it's about controlling what shows up as income, so one decision doesn't set off a chain reaction of taxes and penalties. And when this is done alongside Roth Conversions, it gives retirees a way to manage income carefully during this short window before the senior deduction expires after 2028. That's how the pieces fit together. The OBBBA gave the seniors a tax break carrot, but it's waving a massive administrative stick right behind it. They're now the managers of their own survival. The government isn't coming to save them with automatic anything anymore. It's a trade-off. More cash in the pocket, but more paperwork on the desk. They have until 2028 to ride this tax-free wave before the senior deduction expires, which means right now, they aren't just retirees. They're full-time financial strategists in a high-stakes game of don't forget the forms. Want to see how a simple $5 a day investment can grow into a portfolio that pays more than $8,000 a month in dividend income? Click the video on the screen to find out.